Hey guys, so let's have a little bit of a IPO talk. Now, I talked about this before, which is Klarna is going public. Now, when I talked about this was way last year in 2024. They announced that they were going public, but then they end up pulling back. And so, what I talked about in that video last year, they were supposed to go public in July of 2024, but they ended up putting pause on it because of their whole profitability talk and credit loss. All right. So if you're new to this, the market, you're new to investing, the stock market, now that an IPO just means initial public offering. And it's just when a company becomes public for you to be able to invest in it on the open market. Okay. Before that, the company is considered a private company. All right. There we are. So with Klarna, as of right now, when I talked about this last year, I said I wasn't 100% excited about this Klarna IPO. Honestly, I'm not always excited about a lot of IPOs because of the way that when a company first hit the market and all of that hype is in, there's no data that they're going by to, look at the charts and be able to determine where the hell the stock is going. That shit can go from Klarna is looking at $35 to $37 in opening. And it could pump 20, 30, 40, $50, $100 damn, but it is going to come back down drastically. Okay. And so that's usually with all IPOs. Some of them actually push up and they stay up for a good bit, but a lot of them don't. Right. Now, the thing with Klarna is, well, let me put it like this. If you don't know, Klarna is not a US based buy now, pay later company. Okay. And so one of the things that I said last year was, when they talked about their profitability, they were a profitable company until they opened up to the US market. Okay. Allowing the US to use the platform for their buy now, pay later services. They were profitable until they came into our market. Okay. Over here in the US. And so not only that, they, I think, was it about $99 million lost because of a bunch of loan defaults, and of course they're having their profitability issue here. They also seen a drastic increase in loan defaults here in the U.S. They basically saying, "Hell, we ain't paying our bills over here." But I mean, hey, what can you say for a country that's over $3 trillion in debt? And I'm not talking about the citizens debt, by the way. So they are expected to bring in about 1.2 billion to about 1.5 billion dollars from the IPO. Okay, now this is one of the things that I'm not crazy excited about. It's going to be 34 million shares available, but it's going to be a 10% float. Okay, it's going to be extremely volatile when it hits the market because the float is so limited. We could probably expect it to push up, but we are going to see some massive fluctuation taking place as the time goes by. And quite honestly, it does not take long from a stock to go from its IPO highs back to its IPO open. Now, when it comes to like buy now, pay later companies, I'm heavy on the fundamentals on the back end because it's not much to go by on the technical side. So it was a lot of reading into the fundamentals, reading into their revenue, their profits, their losses, and everything that they're dishing out. The cost of operating, all of that shit. Okay, what their assets, liabilities, you are able to do this. Now, it's a little bit harder to do when the company is not public because a lot of their information is not public and it's mostly based on what is released through the company and just released over time. With buy now, pay later, we see how Klarna mentioned a few things. 99 million loss. They were profitable until they made it over here, and then they have a massive issue with loan defaults. Okay, now that results in a lot of buy now, pay later now using credit, our credit scores, as a means of allowing us to use their platform. And this could result in a lot of people not being able to access it on the scale that we've been able to access it. And I think Klarna, if I'm not mistaken, has 111 million users as of now. Okay, and so if they're checking credit, a lot of us go to buy now, pay later because we can't really get these little traditional loans for some of the basic shit that we might want to buy. You know what I mean? Going to Amazon to buy something and want to break it into four. There are other methods. A firm has monthly loans that actually go by your credit scores, okay? But Klarna, Zip, and all of the others that are here, Afterpay, they did not check credit scores. Okay, so it made it much, much easier for us to obtain those loans to be able to split our payments in four payments to use. Okay, but with the loss that a lot of buy now pay laters are experiencing from loan defaults, it results in them now checking credit, and it will probably result in lesser people being able to access it, or access it in a way that it used to when it first hit the market. Now, another thing too is when I say that I'm not really excited about buy now pay later, because the market can shift at any time, and the way that a lot of buy now pay laters are restructuring. At one point, Klarna had a $45 billion private evaluation. I read about this probably some years ago. This was like back in 2020 and 2021 when this was announced. 45 billion, and that shit dropped all the way to $7 billion. That is a $40 billion drop simply from market shift. Now, I don't get too much into that, but as a startup founder, that's a huge thing, because at any time the market can shift, companies restructure, and with something like Klarna and them experiencing their loss, and they having all of these loan defaults and all of these things, and not being profitable once they made it over here into this market, the buy now, pay later market in that whole space can continue to shift, and we are already seeing it, because a lot of them are not just dishing out buying power, they're moving into credit, like they're checking credit. And this is the thing, because somebody mentioned this, and I've had my accounts for so long. I had it before they made these shifts, but they had a screenshot where when they was trying to sign up for Klarna, and not Klarna, I think it was Zip, the other one, and it popped up and said that they needed to unlock their credit report so that they could make their decision on them using the app. They are not, they're no longer just giving out this buying power and these loans to use the platform. They are shifting to go and do the very thing that they initially weren't going to do. They were supposed to be non-traditional ways of buying now and paying later. The original is what? You get a quick loan or whatever, you get your credit check. They decide, okay, this is how much we can let you get. We let you borrow, go from there. Buy now, pay later was supposed to be interest free, credit, you didn't know credit checks and all of these things, but they're unfortunately having to shift into this side of it, which is shifting into the traditional method of loaning out money. I can definitely see this thing going from $35 to $37. Decide they're going to decide on where they're going to open up. They open up on September 11th, okay? And so I can see it pushing up 20, 30, 40, $50, and then coming back down and then moving sideways for the next 3 to 6, maybe 90 days. Okay. I can definitely see it moving flat, because it's just like it's going to kind of have to find its footing. And then once that IPO hype dies down, then it's just like, okay. So long term wise, I think for me, it would have to be some significant news and some significant additions to the company in terms of if they're going to be stepping further into fintech and a number of other things before I'm just going to hop on and buy a shit ton of shares to say, okay, I see this as a growth stock. Because honestly, I don't. Affirm, on the other hand, I do kind of see it as a growth stock, to where it may not move massively, but maybe 5 to 7% on the year, that we can see some growth there in the stock. Okay, well, the share prices depending on where you are as far as if you're buying the shares. Okay, so I don't know. I heavily anticipate seeing this thing blast up and then come back down, but I definitely want to wait for it to be enough on the charts for me to kind of get some technical side of it, because fundamentally right now it's fine, but it's heavily overpriced in my opinion. But let me say overpriced. It's heavily overvalued, and then it has a very, very, very low float. So unless we see some changes there, I'm not excited about it. But if you want to get it, hey, that's on you. But this is another thing too. If you're using something like Robinhood, you may say, okay, I want to get 10 shares, and it's going to be like $300 some dollars, $307 if you can. A lot of times you probably won't be able to get those 10 shares. They're going to give you what's left. So if you say, I want to request 10 shares before they go public, then when it comes down to it, they say we can only allocate you one damn share. And if it does skyrocket, in my opinion, just leave it there. It depends on what it skyrocketed up to. And of course, you also have to keep in mind when you are buying shares early in a company, in an IPO, is that there's a lockup period. Okay. And the lockup period is where you once you get an IPO, like an IPO share or shares, you cannot sell. Some of them is 30 days, some is 60 days, some is 90 days. It all depends on the platform you're using, okay? So a lot of them have lockup periods, and that means you can't sell. But if you do sell, you might be restricted from participating in other IPOs. Me, I'm currently restricted from participating in IPOs for, I think it said 90 days, because you damn right I sold, because that stock went up like crazy and I already knew that it was coming back down. So I sold. I wasn't tripping. I don't mind waiting 90 days. I have other platforms to participate in IPOs on. So I'm grateful. So that's the thing. That's the lockup period is just something to take into consideration. If you are going to buy, they consider that flipping. Um, ain't that the point of the stock market, to flip our investment? So that's just my take on it on Klarna. I probably won't reserve any shares. I'm definitely not jumping in when they go, once it hits the market, because I don't want to jump in at the middle or at the top and it's coming back down. That's the worst thing you can do, is jumping in at the top. Okay, so I'm going to let this thing play out. I don't care if it goes from 37 to $200 in the IPO. When it jump, hey, whatever. I'm waiting to see what the chart says over the next few months before I make any decisions on hopping into Klarna. Okay, so wherever it is at the time that I decide to get in, I'm cool with that, because I allowed this thing to present to me how it's going to potentially move, where there's going to be a little bit demand at, or where it has been some demand at over the last, upward 90 days. Okay, so that's just my take on it. I highly recommend, if you are going to jump into it, reserve your shares, to look into Klarna as much as possible on your own. Okay, look into their fundamentals as much as you can, and because they are going public, you should be able to find their like their income statements and all of these things on either Yahoo Finance. You can go to Google as well, Google Finance, and you should be able to see all of that stuff, because once they become a public company, all of their finances and things like that are now available to the public. Okay, they are a public company now, so you should be able to do your own research and just pretty much go from there. Okay, so be gentle if you decide to do that. If you want to get one share, hey, do you? It's supposed to open up at between $35 to $37 per share. A lot of times, like right before it actually hits the market, they will finalize what the opening cost would be for that stock. All right, so you should be able to do this on Sofi, Robinhood, Webull, or any other platform that allows you to early access to IPOs. With that, I will see you guys in the next one.